Welcome to Talk Tickers. Today we're breaking down the Q2 earnings call for Extreme Networks. That's ticker EXTR. Let's dig in and see what's really moving the needle for this stock.
All right, so right out of the gate, the stock popped, almost 7% in the pre-market as soon as these numbers hit the wire. So you got to ask, what got everyone so excited? And more importantly, does the full picture really back up that initial jump? Let's find out. Okay, first things first. Let's look at the big, flashy numbers, the ones that really grabbed investors' attention. So here we go. A solid beat on both the top and bottom line. Revenue came in at almost $318 million, which, by the way, is up nearly 14% year over year. And get this, it's their 7th straight quarter of revenue growth. That's some serious consistency. On the earnings side, they beat by 2 cents a share. All in all, a really strong report card. So you see numbers like that and you wonder, okay, what's actually fueling this growth? Let's peel back the onion a bit and look at the operational stuff that's really making the business tick. And right away, a huge piece of the puzzle is their push into recurring revenue. I mean, it's really paying off. Their SaaS annual recurring revenue, that's ARR, has hit a pretty impressive $227 million. And this chart right here, it tells a great story. You can see that SaaS ARR is growing at a whopping 25% year over year. That's actually growing faster than their overall profit. And for investors, that is exactly what you want to see. It means they're successfully shifting to that stickier, more predictable subscription model. And it's not just about the subscription model. They're landing bigger fish, too. Check this out. 34 deals closed this quarter were for over $1 million each. That's a huge proof point that they're moving up market and can win those big, complex enterprise contracts. Now, I love this quote from the CEO. He's quoting one of their Fortune 100 customers, and it hits the nail on the head. It perfectly sums up their secret sauce. Their campus fabric technology is just plain simpler and faster than the competition, and that's how they're winning. So, how are they pulling this off? Well, it's really a three-part combo. You've got AI-driven automation, you've got that unique campus fabric we just mentioned, and you've got flexible cloud choices. This whole tech stack is giving them a real edge. And frankly, it's helping them grab market share while some of their big rivals like HP and Juniper they're pretty distracted with their own massive merger. Okay, so the quarter itself, absolutely solid. No question about it. But there's always a but. When we look at their guidance and listen to the Q&A with analysts, a few, let's call them nuances, start to pop up. And you can bet the market is paying very close attention to these. So here's the first thing. Management basically gave a heads up about some pressure on gross margins coming up. If you look at the Q3 guidance, it's a little bit of a step down from Q2. Now, why is that? Well, it turns out they've won some really big projects. Think massive venue and stadium installations. But that kind of professional services work just has lower margins. So it's good news that they're winning, but it does temporarily drag down the overall profitability mix. All right, and then there's the other elephant in the room. During the Q&A, the analysts were definitely poking around about those rumors. You know the ones, about a potential deal to buy Ruckus Networks. So, how did management handle it? Well, they played it very coy. Didn't comment directly, of course, but they did say their official policy is to always be looking at assets in the market. This basically leaves this big question mark hanging over the stock. We call it an M&A overhang, and it's when that uncertainty about a big potential deal can really just keep a lid on the stock price until we get a clear yes or no. All right, so let's tie all this together. We've got a great quarter, some margin headwinds, and a big M&A question mark. What does this all mean for the stock? And what are we going to be listening for on the next call? Here's our take. We think the business itself, especially that SaaS engine, is going to keep humming along. But investors are going to be laser-focused on two things. Number one, can they show us that gross margins are going to stabilize and bounce back after this little dip? And number two, we need some clarity, any clarity on that M&A story. Until we get answers to those two big questions, we think the stock is probably going to be stuck in a bit of a holding pattern, trading in a range. And that's why we're landing on a market perform rating. Look, there's no doubt Extreme is executing incredibly well. They are taking share, period. But that mix of short-term margin pressure and the whole M&A cloud hanging over them, it just tempers our excitement for now. It makes it hard to see significant outperformance in the immediate future.
And of course, remember, this is not financial advice.